of our conversation on financial data analysis in the last class, and we'd like to continue that conversation now. It's already 8 p.m. and we are addicted to keeping to time, so we have to start. The others will join us as we forge ahead. So in the last class, we started with the introduction, and we looked at the second unit, and we even introduced the third unit, speaking to financial data analysis tools. Okay, so today we'll be continuing where we stopped from the last class, speaking to break-even and cost volume profit analysis, break-even and CVP analysis. We are quite conversant with these tools, but then we're refreshing ourselves back to performance management or management accounting days, costing days, and all that. These are the tools we use for our financial data analysis, mostly that come in requirement 2 at times, and the examiner has tested them in some diets. We need to use these tools, understand what they mean, how to use them to calculate data that we'll use for our interpretation. So what is break-even analysis? Let's start with that. It determines the point where total revenue of a company's proceeds equals the total cost. So startups and other businesses that are just beginning make this a target point to ensure that they either break even or at least make some margin of profit above the cost. So the break-even analysis is a situation where there is no profit and there is no loss. So a company ventures into sales of products and services, and at the initial stage, they target to some extent, and by planning, breaking even, which is whatever they sell should equal the cost. And that's essentially the idea of break-even analysis. The formula is available, and we must first understand the concepts before we go deeper into the calculation. So the key concepts include contribution, speaking to the difference between revenue and the variable cost. So the contribution approach is one of the key concepts of break-even analysis, where you are having your sales price minus variable cost to arrive at your contribution. So these are key concepts that are examinable, and they've been tested severally by the examiner. The contribution approach is a significant approach in financial data analysis. So your selling price, which culminates in your revenue, minus your variable cost, which culminates in contribution, the contribution that is generated for that product or service offered. Also, we have the break-even point, speaking to the number of sales or units of the products needed to cover all fixed costs, not the variable costs, now the fixed costs that are unchangeable in the production of that service. So the break-even point measures that via the number of sales revenue needed to cover the fixed costs. And another concept is margin of safety. Speaks to the excess of actual sales over break-even sales. So the margin of safety is more of a shift from the break-even analysis that revenue equals total cost. So the margin of safety says have some form of buffer above cost a bit, and it indicates the level of risk or a smaller margin of safety, which means higher risk. So it's the excess of actual sales in a bit over the break-even sales. So the margin of safety is a concept that helps stay above the loss level. So where the break-even is at par with revenue and cost, the margin of sales says revenue should be above a bit so that you can be safe. from the loss situation. So we have different methods of calculating break-even analysis. We have the equation method, the contribution margin method, which is very popular. Then we have the graphical method. So the equation method speaks to where your revenue equals your cost. Then you have the contribution margin method where your sales price minus variable cost equals your contribution. And the graphical method speaks to an old method where you have the X and Y axis in a linear method, and where both X and Y is intersecting speaks to the break-even analysis. All right, so that's a bit of the break-even analysis. We can only graphically understand this when we take an example that involves the computation. It will make us remember vividly, and I believe in the remaining 4 past questions we'll be taking, we'll be examining the break-even analysis very practically as the examiner has provided. All right, so let's look at the cost volume profit analysis. Cost for volume profit analysis. Another significant financial data analysis tool is a tool that explores how changes in the volume, that is the number of quantity a company wants to produce in products and services, the changes in the volume, the shift, then also the costs, and also the selling prices affecting profit. The CVP analysis explores this very graphically. Number 1, the volume, that is the amount of products, not in value now, in volume. Then the cost, what it entails to bring that service to the consumers, either direct or indirect, and also the selling prices that brings the revenue and has the difference between the revenue and the profit. So the cost volume profit analysis is a planning tool, is a financial data analysis tool that helps accountants and organizations look at what number of products should be produced, at what cost, and at what selling price will they make profit. That's essentially what the cost volume profit analysis speaks to. And there are limitations of this tool. The assumption is that a single product or a constant sales mix of products, their linear costs and the revenue functions and that of the fixed cost are constant within a relevant range.
Good evening,
so it's
sir.
an assumption. Yeah, good evening. You're welcome, AC.
Good evening, sir.
Yeah,
Sir,
good evening.
it's
You're
raining
welcome,
seriously
AC.
here. I can't hear anything.
Oh, sorry about that. Your network,
Well,
I
it's raining. I
guess.
can't hear anything. I have to quit, maybe. I can't hear. Let
Oh,
me see
no
if I can get
problem.
a episode. No problem, sir. Sorry.
Okay, no problem, AC. Sorry about that. All right. So we're speaking about the limitations, saying that it assumes that a single product or a constant sales mix or the linear cost and revenue functions and that of the fixed cost are constant within a relevant range. So this assumption is stipulated for us to understand that fixed costs don't change. We know that the variable costs change, but that also product and constant sales mix are also fixed. It's an assumption, but then we know in real practice they change. So for the purpose of this study, we assume that this assumption works when we look at examples from the Pathfinder. So that's generally the concept of break-even analysis, and we'll move to another concept or some other tools we use for financial data analysis. Like we said, please feel free to ask your questions, interject very freely where you have concerns or clarifications on the subject. So we'll be moving quite fast. Financial data analysis is quite a voluminous subject, but then no matter how you understand the study text, if you don't take a past question and practicalize it, the case study is going to be challenging to navigate or pass or understand. So please ask your questions freely as we look at these tools, because we'll be running very fast so we can finish on time. Okay, so we're done with that section on the brief overview and refreshing of our minds on the break-even and CVP analysis. Okay, so if we don't have any questions or contributions or any observations, let's look briefly into the product mix and the profitability decision. Product mix and profitability decision is also a financial data analysis, or there are also financial data analysis tools. Yes, please. Thank you, AA. Feel free to interject.
Okay, thank you very much, sir. Please,
Yes,
I'm
please.
trying to understand something. For instance, this break-even analysis, all those things, does it mean we have to just go back to PM to go and revise, or what? Because it's putting that alongside with other things that we are doing again. I just want to be sure that because I was reading through and the textbook, and it was like assumed knowledge is the examiner assumed that we have that knowledge.
Exactly. So it's assumed knowledge, but it won't be out of place to revisit your PM just to refresh yourself on those techniques, because sometimes they are examinable, and if you don't know how to calculate cost, these formulas, you may find it challenging to be able to address a question when it comes that way. So it won't be out of place if you go through and refresh yourself on the key formulas for these areas we are looking at. We may not have the time to start looking at that bit by bit. We want to use the Pathfinder to do the calculations. Like in the first past question, we looked at NPV practically, then some ratio analysis, trend analysis in the last past question. So we want to use the past question to speak to these calculations. So it won't be out of place in answering your question. It won't be out of place. It will be good if you can refresh yourself on the PM, just a glance through, not typical reading like that, going through all the whole PM. So you can just go to financial data analysis to this section, look at your PM where the formulas are, look at one or two illustrations like the ICAN study text provides, and just solve it, just to remind yourself of what it looks like in preparation for when we come up with one of the Pathfinder questions, and most of them are very pepperish. You can at least find your way and will be able to navigate the questions very seamless, because you need to do the calculation to be able to write. Of course, the calculations carry low mark, we understand, but you need those basic computational knowledge to be able to establish a base for you to write. So in answering your question succinctly, yes, I don't mind if you go through your PM again. It will help us to be on the same page. I hope that's clear.
Okay, sir.
Yeah.
All right.
You're welcome. Okay. So let's look at product mix and profitability decision. The product mix speaks to the full set of all product lines. So when a company deals with different products. So for example, Coca-Cola has on its product line the Coke itself. It has Coke, then it has Fanta, then it has Sprite. So that line of product speaks to the full set of all product lines and items that a company offers to the public. So that's the product mix. So it's not a one product company now. We're talking of various products by the same company. And the key decision speaks to either adding or eliminating product or lines. So you either lengthen a line or introduce new lines or new variants to increase profitability. And that's what the research and development section of a business does. They sit down to look at which products are doing well, which products are declining in the group, are contributing well, which new variants could be introduced, which products could be expunged, removed out of the lines. So these are key decisions, and financial data analysis tools like product mix help you to make these decisions. Very important, either adding or eliminating products in the lines, depending on their contribution to the entire product mix. Very important. And the guiding principle speaks to reviewing existing lines. You review their performance over time. You look at what this product is doing, how this product is doing, what value is bringing, what contribution is adding to the whole product line, and what is doing individually. So we have questions like that in different Pathfinders. I think there's a Pathfinder question on November 2024. There's, I think it's on my YouTube page. That was the first video. If you go to that question and download it, the past question, the report is in the description. I would suggest you go there. November 2024 speaks to 3 products: Reagol, Tiagol, and Zeagol. And they are looking at which one contributes profitably to the group or to the mix. And the examiner asks questions on this area, the product mix, and some computational dynamics in that question. So I recommend you go through it, please. I recommend you go through it, and it will help enhance your understanding of this subject we are looking at. It's good you practically understand this so that you could help. It will help you boost your understanding of the concept we are treating in this subject. Okay, so once again, it's November 2024, and I think that that case study question is which company now? Can I remember the company? But just go to my YouTube page, you'll see it there. November 24 is the first video, and the company that we treated, you'll see it there. Trying to, sorry, come again?
That is DEFCON Manufacturing.
No, sir. DEFCON is last year, May 2025. I think this one is, okay, that one is Pago Investments. Yes, Pago Investments.
November 2024.
Travis Hotel.
November
Travis
2014.
Hotel. It's Travis Hotel. Oh, thank you.
Travis Hotel.
Travis Hotel. Yeah.
Okay, Travis Hotel, did they deal with products? Were products provided in that question? I don't think Travis Hotel provided.
Financial analysis.
It's financial analysis. This one I'm talking of, I think, is the first case study, November 2014, is Pago Investment Limited. Pago Investments Limited. I just remembered. So it's November 2014. You can just go to my playlist on past questions on YouTube. You see 3 products there: Reagol, Zeagol, and Tiagol. And it's graphically explaining what we are doing. So you can download the report and just go through it. It's a technical question, technical computations too. If you navigate it, you'll be very well ready for all this. You may not even need to go through your PM, because with that, it will refresh you on how the examiner twists his question on financial data analysis tools. So I really recommend it. Let me even share the link on our group. Let me share the link to that particular question so that you'll be able to go through it, download the report, and we'll be able to understand this very, very seamlessly. Okay, so let's continue our conversation on the key decisions. So adding or eliminating product lines, either lengthening a line or introducing new variants. The primary aim is to increase profitability. Nobody wants a product to die or to be killed. But you see, a product must get to its life cycle, end of its life cycle stage. What they do in research and development is to keep reintroducing new updates, packaging, new things to, you see that the Coke product has stayed and has not been extinct or has not been killed out of the product line of Nigerian Bottling Company, because every day they introduce new innovations, new packaging. It's the same Coca-Cola product, but new things has kept it relevant. And that's what research and development does, had made it profitable, and the product has stood the test of time. So the guiding principle is to keep reviewing the existing lines. So either to add or to update or delete or decide on new and existing lines. One of the lines the Nigerian Bottling Company bought when another company couldn't continue using that product is Limca. Lemka was purchased from another company, and you can see that it's partially doing well in the market. And it's because of the research and development team of Nigerian bottling company that came and forecasted external changes, gauge effects on other products, and they brought that product up. So the guiding principles in adding, deleting, updating, and forecasting external changes helps keep products and their value, their viability in the market. Very important. So that's essentially about product mix and profitability decisions and the concept generally around that. All right. So any question on that session? Any question? Any contribution? Please feel free to contribute. Feel free to enlighten us the more. Please, it's a conversation, and your observations, your contributions are welcome. We have erudite scholars on the call, so we need to learn from each other. So go ahead and interject freely so you can shed more light and let's learn. All right, so the next section will be looking at project appraisal, which is predominantly part of what the examiner brings most of the time. Project appraisal, asking us to use different tools to appraise a project. So project appraisal as a financial data analysis tool helps us to analyze a proposed project or an investment. So you are looking at planning, looking at the profitability of the business based on the data that has been provided to you, and recommend to a client analyzing that project of investment if it will be viable or not. So planning or financial data analysis in this area is the essence of the project appraisal. So don't introduce unrequested or new information in your calculation. Very important. So be presented with data provided to us. Don't say this is incorrect, this is not realistic. Please use the data and state your assumptions unequivocally in the examination. So this is now an examination note the examiner is saying. A key takeaway is when you have a project appraisal, deal with it like that. If from your analysis and computation, the appraisal or from your calculation, it's a negative NPV, please go ahead and recommend or conclude based on that. Don't introduce unrequested new information or calculations or numbers that were not in the question. Very, very important. And the examiner is saying this to warn students critically. Use data that was provided to you from the exhibits only. Don't have a case in your mind and you decide to use the data in your head or in your mind. So don't change anything. Use the data for your computations in the examination. Also use the specific analytic tool or analytical tool suggested or requested by the information provided. So where an analytical tool or a data analysis tool is expressly requested by the examiner, please go ahead and use it. But where it's not requested, you can now provide. So for example, payback period, not MPV, if only payback period is requested. Please follow the examiner's prompt, his command. It's very important for the case study exam. In the last diet, November 2019, we saw that we're supposed to do a project appraisal, but we are not given the technique. And from the data provided to us, we just knew it's MPV, the net present value method we're supposed to use, and we used it. But where in a scenario like that, you are asked to use payback period. But from the numbers, you see that payback period please use the payback period. Then during maybe your challenge and considerations and your conclusions, you could just state that NPV could be used in your argument, but don't use NPV when you are asked to use another method. This is very critical. So we'll be looking at the techniques for project appraisal, and we have the non-discounted payback period and the accounting rate of return. We may need to look at the non-discounted and the discounted. So the payback period are not discounted because they don't have hurdle rates. They don't have cost of capital. And that is why they are non-discounted methods of appraisal. And there are techniques that are non-discounted. So we may need to go back to understand the formula and the dynamics of calculating it. They are very simple, in my opinion. And we also have the discounted that have hurdle rates, cost of capital, and speaks to the net present value, the IRR method, which is the internal rate of return, and the profitability index. But more predominantly, the NPV is predominantly used by the examiner or tested by the examiner. The IRR and the profitability index, I've hardly seen questions that featured these tools. Also, the payback period and the ARR has not been featured in, I think, any of the case study past questions. I think for the last 22 diets that he has tested or that the case study paper has been in existence. So we may need to refresh our memory back on these simple formulas. I think the most challenging or the most technical is the NPV in all of them, looking at the present value, the future value, and all that. So the IRR also is quite where you use the interpolation method and you get the first, the second, and all that. The computations could be a bit dicey, but then if you have a good scientific calculator, they are navigatable. If you practice and under exam condition, you should be able to come up with values that you speak to. So the exam technique speaks to the application. The application, very important. The exam technique is you apply your judgment to demonstrate your skills. No matter how the technique or the tool you're asked to use, if you don't come up with analysis and make your decisions, you will earn very less marks for just calculation. And that has been said over and over again. So you must apply your judgment, demonstrate your skills using the computation into interpretation. Then you can create new assumptions for a different calculation, though it will not earn you any marks, but then don't replace what you are expected to calculate. Calculate what you are asked to calculate in the exam. Then you state your assumptions very clearly in your write-up. So that's generally the technique on how to deal with the case study paper under exam condition. Okay, so that's it about project appraisal in summary. Any question for that section? Any question on that question? Okay, I believe we are deciphering it seamlessly. Okay, so let's look at section 6 on financial data analysis tools, section 6. We're looking at decision making now because at the end of the day, everything about our calculation and provision of information in writing to our client, to the board of directors, and whoever it is that is a recipient of our report in the case study paper speaks to decision. What decision would they make that will move the organization forward, that will cause a shift, that would move them in their business, in the business space to where they desire to be. So you are an advisor and you're provided with exhibits or a scenario of where the company is and where it wants to be. So at the end of the day, your conclusion and recommendation should sprout decision making. And CIMA, the Chartered Institute of Management Accountants in the UK, said effective decision making is the process through which alternatives are selected and then managed through information to achieve business objectives. And these alternatives are provided to us or to management via your conclusions and your recommendations. So the different 8 boxes, your discussion from the first box, the use of data and information, the second box, the explanation of your professional tools, the third box, your analytical skills that you're displaying, the fourth box, the challenges and options, the fifth box, your ethical considerations and critical analysis, then the sixth box, your evaluative skills and judgment, speaking to risk assessment and whatever it is you are pointing out in the case. Then your seventh box, conclusion recommendation, should help manage implementation and achievement of the objectives by helping the board make decisions. So that's generally what your discussion is all about. It's not just to write or communicate, it's for the business to make decision to achieve their objectives. Very important. Also, Drucker Peter, the guru, the management expert in 1967 said, effective decisions result from a systematic process with clearly defined elements. So those elements are what you provide for the decision or systematic process of thinking that is handled in a distinct sequence of steps. So having spoken about these 8 boxes, the board goes through that. It helps them make effective decisions because you have provided them with variables and a lot of data in very comprehensive language, and those steps would help them make decisions. And the decisions could be short-term and they could be long-term. Short-term decisions speaks to day-to-day decisions, operational, speaking to tactical decisions, what to do, how to do. On the frequency, so short-term is maybe 1 month, 1 day to 30 days, 30 days, or 1 month to 3 months, 3 months to 6 months, 6 months to 1 year decision based on operational needs and obligations. Then we also have, which is not stated on the screen, long-term decisions that are with 1 year to 5 years, 5 years to 10 years. And these decisions are management-inclined decisions that must be made. So long-term are mostly strategic decisions, while short-term are operational and tactical. Very important. And the characteristics of decision-making, you do not consider the time. So do not consider the time. The time value of money and fixed cost are generally excluded from these decisions unless they are new. Of course, the time value of money impacts decisions. We know that. But in our case study context, in our analysis, in preparation of the report, we must understand that the time value of money should not be considered. So your computation should reflect what is in the current. So if you're doing future value, for example, for NPV, you just show the future value of the projects you are appraising, maybe for 5 years. And you show, okay, if the product is going to be viable or not based on what you've computed on the present value. So the characteristic is that do not consider the time value of money and the fixed costs are generally excluded unless they are new. That's what the examiner is saying on this slide. So for the key principle for the decision making involves focusing on relevant cash flows. Relevant cash flows was the cash flows that are coming in for those years. And they are futuristic, of course, and they are incremental. And they may also be cash-based. But in every question, you must ignore sunk cost, that is past cost. And non-cash items like depreciation that are non-cash should be ignored. And most of the questions, the past questions you see, you hardly see questions on sunk cost. In fact, it has never featured or depreciation. Where you have depreciation is a situation where a forced requirement maybe asks you to add back depreciation for a decision you want to make on the financial statement or something. But for decision making, which is financial data, you hardly have such scenario, and that's the principle the examiner has painted practically. And if you look at the trajectory of his reports and past questions, they follow this order they are stated in the study text we are using to have this conversation. So having looked at the key principle, also opportunity cost is also another key area that helps decision making. It's the cost of the next best alternative you sacrifice when making a decision. And we know that it applies only to scarce resources where you have to make a decision. So you pick the best based on the alternatives you have. It's also a tool for decision making. Then, okay, we're talking about long-term, short-term. I didn't know it's on the slide. Like I said, strategic decisions that affects the company's overall objective, mostly in the long term. And they're often major capital expenditure assets that involve heavy funding are what long-term and strategic decisions speak to. So the balancing act is about the short-term decisions and the consequences it will have on the long term. So whatever you're doing in the short term, you must be futuristic in your approach, affects the long term. So your day-to-day is what determines the future of that business. So good decision making considers the long-term impact and effect on the business. So a tool like balance scorecard, the financial aspect, the customer aspect, the processes aspect, then the staff training, those 4 cardinal, the balance, 4 financial, customer, internal processes, then staffing. Those 4 tools helps shape the decision in the short term and the long term of any organization. So you may need to do, we'll look at the balance scorecard as a performance management tool in chapter 6, of course. So we'll be exploring that graphically, but then you must understand the balancing act of the short term and the long term in decision making, which is critical for any business to survive and thrive in the business landscape. All right, so that's it about that short point on short-term and long-term decision making. Let's look at the next session. If you don't have any question or contribution on the risk and uncertainty, very important. Risk is part of business, and risk can be positive and negative. So risk in terms of negativity speaks to dangers and what you need to do to mitigate it. And risk can also be opportunities that you explore in terms of investment to get profit. So risk is two-way. Then uncertainties are a lack of sufficient information about the future outcome. But if you have a positive risk item you identified, you're going to make an investment of 10 million, and you're going to get a return of 10 billion. So what is the risk of not getting that return? And that's a positive or an opportunity, not a threat. And you must look at risk in that perspective. Yes, please.
Yeah,
Somebody is interjecting.
Good afternoon.
Good evening.
Good evening.
Good evening. Yeah, good evening.
Yeah. I'm just thinking this risk and uncertainty. It means under PM, topic like sensitivity analysis could be tested.
Yes, we'll be looking at it also under this subject, of course. So it has never been tested anyway,
right,
but then sensitivity analysis could be tested. We'll be looking at it under these financial data analysis tools. Okay, so thank you for bringing that to the fore. So the lack of sufficient information speaks to uncertainty, and it can be reduced but not eliminated. Uncertainty's risk cannot be eliminated by gathering more information. So your uncertainty is only uncertain because you don't have information. But when you have information, you begin to have some level of certainty. And that's what information does. So information gathering, market research and development helps you have information to make decision. So somebody is blind or you don't have a headlamp, you can't drive. But when you have a headlamp, you can drive because you are seeing. And that's what uncertainty generally, the concept around uncertainty speak to. A business may be uncertain of where it's going to or what it wants to achieve because it does not have data or information to work with. And that's what uncertainty is all about. Then risk talks about when there are several possible outcomes and you can assign probabilities to them. So risk can be analyzed statistically. So like I said, you have positive or negative risk, and the outcome is very important because when you identify a risk, you need to assess it. When you assess it, you look at the probabilities of you losing your investment, then you put mitigants in place and look at the probability of losing or winning. It can be analyzed statistically based on data you have. One of it is risk preference. Risk preference. What do you prefer to invest in? What do you prefer to invest in? And in the risk world, in practice, the risk preference could be seen as your risk appetite. What do you want to do? Your appetite. When you want to eat, you prefer to either eat a pounded yam or eat rice. So your appetite for which one is more? So when you look at investments, for example, I love to do investments in real estate than shares. So my appetite or my preference for risk is more on real estate. I prefer real estate than doing shares or bonds or other stock. So your risk preference, it describes a manager's attitude towards risk. What do you prefer? And that's what risk preference speaks to for businesses. Then being risk averse means avoiding risk unless a higher return justifies it. So most managers are assumed to be like this. Of course, you must be risk averse because the higher the risk, they say the higher the return. So you must look at investments that bring you the highest return. Like I said, I love real estate investment, they are risky, but then when you buy a property, for example, this year, and after 10 years, you find out that property, especially if it's in a good location, has appreciated. So that justifies the higher return. And maybe I buy a property for ₦1 million, and after 10 years, I'm selling it for 50 million, depending on the development and the expansion, the way the area has developed. So you can't avoid risk. You just have to embrace it and justify it by the returns you get. And most managers that are very good in this help to manage their risk. And that's why the second line of defense of any business, based on the Institute of Internal Auditors model, we call it the IIA 3 lines model. We have the second line of defense, which is risk management. And every business that must thrive must have a very, very active risk management function, or risk managers that manage risk at a very proactive level. This is very important. So being risk averse is good because you look at your return and what you need to forego to earn that higher return. Very important. One of the apostles of investment of our time is called Warren Buffett. He's a very good risk manager. He's one of the most successful investors currently on earth. His risk team are, yes, please, I can see at the AA's hand. Please go ahead and interject. Go ahead.
Sorry, sir. Please, you did mention the 3 level of what's it called? And I just forgot now. When you mentioned the fact that the second level is risk management.
Okay.
I want to
the 3 lines model, Institute of Internal Auditors, the IIA model on 3 lines model. Yeah, I'm just trying to remind you.
Okay, so what's the 3 line model? I want to.
Okay. So the Institute of Internal Auditors came up with a model. Formerly, when it started, they called it the 3 lines of defense. Then they changed it. They don't want to use that word defense. That word defense sounds more like being reactive. So they removed that 3 lines in 2020, that defense, and called it the 3 lines model. So the 3 lines model is a concept whereby the functions or activities of the first, the second, and the third lines help to protect an organization from fraud, from crashes, and corporate collapse. So generally, after the Enron and WorldCom and some other corporate collapse that came up in 2020, the 3 lines model preceded that, but it was reinforced to have that 3 lines model say, okay, an organization shouldn't crash if these 3 functions or these 3 lines are there. So it's like a building. When you want to attack somebody, you come in through the gate. The gate is assumed to be the first line. So if you pass the gate, you get to the living room door. You have to knock, second line. Then before you get to the person, maybe his room, the door is the third line. So if you look at a castle or a house, it gives you an idea on what the 3 lines model is. So based on the Institute of Internal Auditors idea is that the first line are the process owners. So for example, the branch manager, the head of department, the finance manager, every unit head is a first line of defense. So what the people do, those people do is they bring the risk, the activities, the transactions, day-to-day processes. So they are the process owners. In risk management, we call them the risk owners. And they bring the risk. Then they are also primarily they should primarily put mitigants in place for those risks in practice. So for example, the finance manager prefers invoices, makes payments. He should ensure that what he's doing is legit and what he's doing is based on principle, based on approvals and all that. So that's the first line of defense. Then the second line speaks to risk management, internal control, compliance. So all these roles belong to the second line of defense. So whatever the first line does, the second line of defense will check it. Like the risk management, for example, prepares policies or helps with policy interpretation, identifies risks, mitigates them, prepares risk register, risk assessment. So the internal controls also based on the COSO framework looks at the control environment, look at risk assessment, look at control activities, look at monitoring, and also looks at information and communication. So the internal control helps to back the first line of defense in ensuring that whatever passes that first line will not pass the second line. Then the third line of defense are the internal auditors, internal and the external. So the internal auditors form the third line of defense in the sense that they assess the efficiency and the effectiveness of internal controls. They also check the risk management processes and their general duties. They also look at the compliance to external regulations and internal policies of the organization. So the internal auditors provide assurance services, and they are generally looking at the whole landscape of the business. They are not specific. They are not focused to the particular area. So the internal auditors look at everything: finance, health and safety. Every unit is examinable. But the other part of the third line of defense are the external auditors, and they are specific on financial statements. Of course, the internal auditors look at financial statements at a peripheral level, but to avoid duplication of effort, what the external auditors come to do is they come to provide clarity as to the financial statements if they are prepared in line with applicable framework, either the IFRS or the GAAP, and their position and their opinion is provided on the trueness and the fairness of the financial information of the financial statements. So generally, the three lines of defense model that's the idea, and in practice, most organizations employ it. So where you have the first line, which are generally the unit managers, the CEO, everybody on that first line, you have a separate risk management function. For big organizations, you see a robust unit up to maybe 20 members in the risk team or the risk unit. You have internal audit, depending on the largeness, you see as much as 50 internal auditors, depending on the largeness of the organization. Organizations like Tesla, Microsoft, they have robust three line of defense model team that head those units. So that's generally what the IIA model is all about on the three lines model. And the risk is an integral part of that model. I hope you got some thoughts on that.
Sure. Thank you very much.
Okay. All right. You're welcome. Okay. So we're looking at being risk averse, and we said you have to embrace some part of risk to get some returns. Of course, you can't be risk crazy. I call it risk crazy because investments like MMM, C-Best, I've always told people, I'm a chartered accountant, those ideas don't work. Before they crash, people come to meet me, what do you think about this? And I said, from my little years experience in chartered accountancy, you can't guarantee me this kind of returns. I call it nonsense returns because they don't make sense. They are on no basis. So MMM came and a lot of people, you are not. Yes, please.
I say about crypto.
Yes, please, go ahead.
Crypto.
Okay,
but it's like
is...
they are now accepting crypto international media, right? On the analysis, you see the analysis. I don't know.
Okay, well, from the risk perspective, I won't venture into crypto for now because the return mechanism is not that clear. Of course, it's legit. The federal government has proved it. In fact, IAS 38, intangible assets, ICAN and the ACC and other, in fact, IFAC has already integrated it into IAS 38. So, but the general perception of crypto now is the unclear return mechanism. We are still unclear on its return. It still looks like a scam, but it's not. Legally, it's... In fact, the last Minister of Information in Nigeria came to clear the air on crypto. And I think his name is Issa Pantami, the just outgone Minister of Communication. So it's legit, but I personally won't invest into it because I'm not clear on the return and how to get my money back. I would rather have my money in real estate and let it be there for a particular time. I haven't looked at the area I'm actually investing in. So that's my preference. So it depends on your appetite. If you know the return is good, there's this one they used to do. They'll be punching something on the phone. I don't think that makes sense. What did they call it? Tapping or what? This is part of the crypto. It's something they tap. You see some people pressing phone. That does not make sense, in my opinion. In fact, it's highly risky an investment. If you're tapping something and they said it's part of the crypto. Well, I'm not clear on crypto, but if you're clear on the return and its mechanism, please go into it. It's legit. So speaking to risk management, whatever it is, be return conscious. How will you get your money back? How do you, worst case scenario? And that's what business is all about. Whatever the risk is, you should be able to have some measurable level of return. So whether it's crypto and whatever investment it is, you will see somebody like Warren Buffett, he's going to invest in Israel. Israel is a highly volatile area that is in war almost every day. But he has investments and business in Israel. You're wondering how he's doing it. But at the end of the day, after the war, you see him come up with proceeds. Not because of the war, but because of the resilience of those areas and how they bounce back. So when you read books like that, you see that they are return conscious. This very, very successful for business people, return conscious. So when you look at the risk, it's very true that the higher the risk, the higher the return. So whatever it is, crypto, but then Ponzi schemes like MMM, CBEST, and some other, no, they don't make sense to me. They don't. I'm sorry to say, they are not risk calculated. So make calculated risk as managers, calculated risk. Look at it, sit on the table, work out the dynamics, work out the numbers to arrive at your conclusions so that you can make your decision. Very important. Okay, the next one is being risk neutral. And being risk neutral means ignoring a risk and select the option with the highest expected return. So your being risk neutral is also good. It's a positive advantage. So you look at risk that brings the lesser return and you select the option with the highest expected return. And that's being rational as a business person. Very important. Okay, so being risk-seeking speaks to taking on extra risk for the hope of a higher return, which is also good. If you are making an investment, you have to look at the return. So the return should motivate you to take more risks, but be calculative as a business person. And the tools speak to what you are expecting. The expectation of values, speaking to the weighted average of the positive possible outcomes. And that is why you have a cost of capital. Most of the time when you are doing discounted value, you have the cost of capital that gives you the cost, of those expected values or the future or the present values that will provide the future for you. So the decision rule is to choose the highest expected profit or the lowest expected cost. Of course, everybody wants to increase his income and reduce his cost. That's the decision rule of every business person, every individual. And you can achieve that by decision trees. Decision trees are used for multi-level decision. It's a methodological way of calculating expected values futuristically by showing all your possible outcomes and probabilities and choosing among them. So in the case study exam, for example, you have plethora of options. So to achieve superior value, you have to give 4 superior points for each box. So when you do that, you are providing decision variables for the board of directors or your clients to choose among them. So we can call them decision trees based on those boxes. But based on this idea, you have a way of calculating your expected values and choosing from them based on the probabilities and what you feel is the best course of action at that point. And we have also the value of perfect information that removes uncertainties or reduces uncertainties. The maximum amount a manager would pay for information that guarantees the outcome of a decision is very important. Information is key. You can have information and it will help your business thrive. But where there's no information or data, you are in the blues. You don't know what to do, and that's where uncertainty comes in. So information is key. Information makes you move from a mediocre business to a thriving business. Information, very important. So that speaks to that section on risk and uncertainty. So somebody asks now on sensitivity analysis, which is saying we may be tested on. It has not been brought in any of the 22 diets, but it's an examinable area. And you can also refresh yourself with the calculative aspect of it. So what is sensitivity analysis? It's a method that very simply tests changes in key variables. So you have, for example, your sales volume that culminates in revenue. And you have material cost, the cost either direct or indirect. When you talk of direct cost, you are talking of the cost of goods sold. That's looking at the financial statement way of putting it. But the cost of goods sold is actually the direct cost of bringing that service from raw materials to work in progress to finished goods. So that's the material cost, looking at it from that perspective. Then the indirect costs are costs like admin, distribution, and selling. So it affects the outcome of a decision. So you have to, it's sensitive. Why is it sensitive? Because you have to be careful. And that's what sensitivity analysis speaks to. These key variables must be made carefully. And the steps include, you determine the original plan. What did you budget for your revenue? What did you budget for your cost of sales? What did you budget as your gross profit? So a budget must be in place for you to be able to perform sensitivity analysis. Very important. The number 2 step is to identify and change the value of the key variables, either moving them up or down, either by 5% or by 10%. So the key variables for each budgeted amount, you identify and change the key variables. So you are being sensitive, and that's where sensitivity analysis comes in. It tests how changes in these key variables affect decision making and possible outcomes. After you've identified the change and the values of the key variable, you recalculate the outcome to see the impact. What will the impact make after you've moved your budget from a particular percentage to a particular percentage? So when you do the recalculation, and that's what most businesses do, we do incremental budgeting. If this year we did a particular amount of revenue, next year we look at it, okay, let's do 10% more to sprout us to work harder. So you recalculate the outcome to see the impact or the effect. So these are the 3 cardinal steps on sensitivity analysis. Sensitivity analysis. And what's the purpose of sensitivity analysis? It helps identify the most critical variables on your product mix. You assess what will happen if the estimates are wrong, and what will also happen if they are right. So it's very important, and that's why it's called sensitivity analysis. They are very sensitive. They could close down your business. So those decisions must be made carefully. It also helps decide if the risk is too great to produce with or to proceed with a plan. So sensitivity analysis is a good tool to help you assess risk and help you make decisions carefully. So for the case study exam, there's a tip here. The examiner said, don't just recommend that sensitivity analysis should be performed. Don't do that. You must actually carry out a simple analysis or comment on the likely impact of changing a key figure. Take note of that. Don't just recommend in any of your conclusions that, okay, recommended that sensitivity analysis should be performed. I think I've looked at almost the last 22 diets. You hardly see such recommendations, and it's disrecommended for you to do that. So you need to make or perform a simple analysis or comment on the likely impact of the sensitivity analysis you want to perform. Okay, so ladies and gentlemen, I just checked my clock now. It's 9 o'clock. All right, so I've landed safely. We are on section 364, business and investment violation. Let's stop here